Day sales outstanding, average accounts receivable over net credit sales times 365. Day sales outstanding, average accounts receivable over net credit sales times 365. Day sales outstanding, ending accounts receivable over net credit sales times 365. Day sales outstanding, ending accounts receivable over net credit sales times 365. Day sales outstanding, 365 over accounts receivable turnover. Day sales outstanding, 365 over accounts receivable turnover. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, ending inventory over cost of goods sold times 365.
All right, welcome again today to our study time. Father God, thank you for this beautiful day again today. We're about to end the month of June. We thank you, Lord, for all the blessings that you have given us throughout this month. We always ask you, Lord, for knowledge, intelligence, for wisdom and understanding. Forgive our sins. We pray in Jesus' name. Amen. All right. The company records credit losses adhering to the current expected credit loss model. During the year, the company wrote off a customer's account receivable. What impact does the write-off have on the company's net income and total assets? Net income. Write-off does not affect net income. Total assets. What happened? What really happened? Records credit losses adhering to the current expected credit loss model. During the year, the company wrote off a customer's account receivable. To write off an account receivable, you write it off. Write-off doesn't have effect on net income. What about total assets? When you write off an account, you remove it from accounts receivable, so it does not exist anymore. That would decrease accounts receivable, but let me see what the thought is. Okay. You write off an account. Okay. This is one of the most important concepts in the trade receivables chapter. Once you understand what has already happened versus what is happening now, you'll never miss this question again. What is the question asking? During the year, the company wrote off a customer's account receivable. The key phrase is wrote off. That means the company already estimated this loss earlier under the current expected credit loss model. What entry is made? When a specific account is written off, debit allowance for credit losses, credit accounts receivable. So accounts receivable will go down, allowance for credit loss will increase. Allowance for credit loss debit $5,000. Accounts receivable credit $5,000, for example. Notice something important. No bad debt expense, no credit loss expense. Those expenses were recorded earlier when the allowance was estimated. Net income. Does this journal entry touch an expense account? No. Therefore, net income, no change. Total assets. Before the write-off, accounts receivable was $100,000. Allowance equals $10,000. Net receivable is $90,000. Total assets include net accounts receivable. After writing off $3,000, accounts receivable equals $97,000. Allowance equals $7,000. Net receivables still equals $90,000. Look carefully. 97 minus 7 is 90,000. The asset did not change. Therefore, net income, no change. Total assets, no change. Write-off, immediately think allowance goes down. Whenever you see write-off, immediately think allowance goes down, accounts receivable goes down, nothing else changes. Okay, allowance goes down, accounts receivable goes down, nothing else changes. So memorize this. In the event record expected credit loss, net income goes down, total assets go down. Write off a specific account, net income no change, total assets no change. Recover a previously written off account, net income no change, total assets no change. This is one of the foundational rules of the chapter and appears frequently on the CPA exam. Okay. I need a table like that. A table of events and the changes that happen based on the event. Let's say, like how we just did it here. Record expected. Let's say we have a credit loss. A credit loss, net income goes down, total asset goes down. Write off a specific account, no change. Net to net income, no change to total assets. Give me a table like this. and whatever write-off affect, and give me a table that where write-off affects something, or where it goes down or where it goes up. Oop, that's a lot. That's too much. Okay, let me see. Trade receivables event table. Okay. Records, expected credit loss, bad debt expense, accounts receivable, allowance for credit loss, net income, total asset. That's too much. No. Record expected credit loss, journal entry. Yeah, I believe it's better to understand. Yeah, in this case, it's better to understand than to memorize, because this is too much. So I want to understand the write-off. I know what it is, but give me a timeline of events and what that event would cause. Let's say you sell the product, you sell it on credit, it creates the accounts receivable. In the accounts receivable, you need to collect the money. The customer does not pay, and you know this customer will not pay, you write it off. What happens when we write off the account? And then after write off, we recover the account. And then what happens when do we have the current expected credit loss? So give me a table like this. I believe that will help me understand better. Step 1. Sell goods on credit. Journal entry, debit accounts receivable, credit sales revenue. Net income goes up, total assets goes up. Estimate some customers will not pay. This is the current expected credit loss. You debit credit loss, expense your credit allowance for credit losses. Net income goes down, total assets goes down. Wait for payment, no entry, no change, no change. You're giving the customer time to pay. Customer does not pay. You know the account is uncollectible, so write it off. The entry is debit allowance. Your debit allowance, your credit accounts receivable. Okay. Net income, no change. Total assets, no change. The loss was already recognized in step 2. You're simply removing the bad account. Okay. Okay. If the customer never pays, no further entry, no change, no change. The story ends here. Unexpectedly, the customer decides to pay. You restore the account first. You debit accounts receivable. You credit allowance. Net income, no change. Total assets, no change. You can't collect an account that no longer exists, so you put it back on the books. Put it back on the books. Receive the cash. You debit cash, you credit accounts receivable. Net income, no change. Total assets, no change. Cash replaces accounts receivable. One asset replaces another. The story in plain English. Day 1, the sale. You sell a TV for $1,000 in credit. The customer promises to pay later. You now have an asset, accounts receivable. Day 30th, you look at all customers. You think some customers won't pay me. You don't know exactly who, so you estimate that maybe $50 will never be collected. This is when the current estimated credit loss happens. Notice you have not written off anyone off. You have not written anyone off. You're only estimating. This is the only step where the expense is recorded. Day 90, one customer files bankruptcy. Now you know the specific customer will never pay. This is not a new loss. You already expected losses months ago, so you simply remove that customer's receivable. No new expense. 6 months later, the customer wins the lottery. They call you, I can pay now. Problem. Their receivable no longer exists. So first you put it back. Then you collect the cash. Still no new income or expense. Still no new income and expense. The biggest idea of the chapter, there are two completely different decisions. Decision 1, how much do I expect to lose? This is an estimate. This creates credit loss expense, allowance for credit losses. This affects net income, total assets. How much I expect to lose. It affects net income, it affects total assets. Decision 2, which specific customer won't pay? This is the write-off. You're only identifying which account makes up the loss you already estimated. No new expense, no change in assets. Think of it like a bucket. Imagine a bucket labeled allowance for credit losses. When you estimate future losses, you put $10,000 into the bucket. Later, you discover customer A owes $500 and won't pay. You don't record another loss. You simply take $500 out of the bucket to cover that customer's receivable. That's why the write-off has no effect on net income. You already filled the bucket when you recorded the expected credit loss. Okay. I want to do this question again. The company received from a customer a 1-year $500,000 note bearing annual interest of 8%. After holding the notes for 6 months, the company discounted the note at a regional bank at an effective interest rate of 10%. What amount of cash did the company receive from the bank? This one we can think it through. Okay, so you have $500,000 note with annual interest 8%. You have already held the note for 6 months, and you discounted the note at a regional bank and at an effective interest rate of 10%. What amount of cash did you receive from the bank? You sold it at an interest rate of 10%. So $500,000. $500,000, 8%. $500,000 times 8%, 0.08 is $40,000. So at year end, you would receive $540,000. Discounted the note at a regional bank at an effective interest rate of 10%. Let me do 500,000 times 10% times 10% times 6 divided by 12. Okay, I don't think my calculation is off. Let me. Simplify this question the same way we've been. All right, so what do we want? What do they want? What amount of cash did the company receive from the bank? That's all they want. Step 2, what do we have? We have face value 500,000, note term 1 year, stated interest 8%, held for 6 months, bank discount rate 10%, discounted after 6 months. Step 3, build the timeline. Day 0, received note, 6 months after discount at bank. So when the company discounts the note, there are 6 months left until maturity. The bank is buying the note from the company. Step 4, what is the note worth on the maturity date? At maturity date, the bank will collect the principal of $500,000. Interest for 1 year, 8%, which is $40,000. Total maturity value is $540,000. This is the first number you should always calculate. Step 5, the bank wants a 10% return. Oh, the bank wants a 10% return, yes, but only for the remaining 6 months. 10% annual, 6 months equals 5%. So the bank discounts the maturity value by 5%. Cash received equals $540,000 divided by 1.05 equals 514,286. That number is not one of the choices. Why? Many CPA questions using bank discounting use a bank discount instead of present value. bank discount, maturity value times discount rate times time. So 540,000 times 10% times 6 divided by 12. This is exactly what I was doing. Yeah, that's 27,000. Cash received. Oh, I see. 540,000 minus 27,000. 513,000. Okay. I see. But I could have done 540,000 times 90% times 6 divided by 12. Let me see. I did 500,000. Oh, I should have done 540,000 times 10%. Times 6 divided by 12. 10% times 6 divided by 12. If I do, that's why I have 25,000, but it's 27. But 540,000 times 0.990% times 6 divided by 12. Ooh, 243,000. And no, 513,000. I need to see how 540,000 times 10% times 6 divided by 12. 27,000. That gives me the $27,000. Okay, so 540,000 minus 27,000. Okay, that makes sense. So the train of thought was good. But the first thing we need to do is to add the interest. $500,000. The interest is 40,000. So it becomes $540,000. That's the value. Now the bank wants to discount this at 10%. So that's where you're gonna do $540,000 times 10% times 6 divided by 12. 6 months left divided by 12 months of the year. Okay. I want to do this question again. The following information relates to the company's accounts receivable for year 2. Accounts receivable January 1st, year 2, $650,000. So we could consider this beginning accounts receivable. Credit sales, we have $2,700,000. Accounts written off. Accounts written off, you write off an account, $40,000. Collections from customers is $2,150,000. Estimated future sales returns. Sales returns at December 31st, year 2, $50,000. Estimated allowance for credit losses, $110,000. What amount should the company report as gross accounts receivable on December 31st, year 2? Gross accounts receivable is sales minus discounts. Gross accounts receivable. Credit sales minus no collection, accounts written off, no written off, estimated future returns minus returns, accounts received, credit loss, accounts written off, collection, estimated future sale, return, estimated allowance for credit loss minus returns. I believe the Gross accounts receivable is net credit sales minus returns. That's what I would do. Return is $50,000. Return is $50,000. Net credit sales is $2,700,000. Yeah. Let's see what we got. This is another one where the math is easy once you know what account you're solving for. What do they want? Gross accounts receivable at December 31st, year 2. The key word is gross. What that means, ignore allowance for credit loss, estimated sales return, or ignore return. Those affect net account receivable, not gross accounts receivable. Okay. Step 2, build the accounts receivable T account. Think of accounts receivable like a checking account. What increases accounts receivable? Beginning accounts receivable, credit sales. Okay. What decreases accounts receivable? Collections and write-offs. So the question is, ending accounts receivable equals beginning accounts receivable plus credit sales minus collections minus write-offs. Plug in the number. Okay. Estimated future sales return. Estimated allowance for credit losses. They are not part of gross accounts receivable. They are used only to calculate net realizable value. I see. Okay. So that's the equation you were practicing yesterday. Ending accounts receivable equals beginning accounts receivable plus credit sales. Beginning accounts receivable plus credit sales minus collections minus write-offs. Accounts written off, you write off. Collections from customers. Okay, credit sales. Accounts receivable, you have beginning accounts receivable. You have credit sales. Accounts written off minus write-off minus write-offs minus collections. That will give you ending accounts receivable. Gross accounts receivable. If you wanted to calculate net accounts receivable, you would subtract returns. And also allowance for credit losses. You would subtract allowance for credit loss. You would subtract returns. But since you're calculating gross accounts receivable, the formula is beginning accounts receivable plus credit sales minus write-offs minus collections from customers. Okay. This not too hard. So $1,160,000. Okay. The company uses the probability of default method to estimate credit losses. The company determined the net carrying value of its accounts receivable at December 31st, year 4 as $235,000. the following additional information available from the accounting records. Allowance for credit losses, January 1st, year 4, is $40,000, which is considered as beginning accounts receivable. Uncollectible accounts written off during year 4, $22,000 write-offs. Uncollectible accounts recovered during year 4 is $8,000. This is collection or recovery. Accounts receivable at December 31st, year 4 is $270,000. What amount was recorded for the credit loss expense on year 4 income statement? Credit loss expense. The company determined the net carrying value of its accounts receivable at December 31st, year 4 as $235,000. Net carrying value. The following is additional information. Allowance for credit loss, uncollectible accounts receivable at December 31st, year 4, $270,000. The company determined the net carrying value of its accounts receivable at December 31st, year 4 as $235,000. But the actual accounts receivable at December 31st, year 4 is $270,000. So there is a difference of $35,000 here. We need the credit loss expense. Allowance for credit losses was $40,000. Okay, so let's see how we can attack this question. It's working. Okay. This is one of the classic allowance for credit loss questions. Don't think about the math first. Think about what they're asking. What do they want? Credit loss expense for year 4. Whenever they ask for expense, your brain should immediately think, I need the required ending allowance account. Yes, I need the required one. That's true. So that I can find the expense. What is the required one? What do we have? Beginning allowance $40,000, write-offs $22,000, recoveries $8,000, ending accounts receivable $270,000, net carrying value $235,000. Step 3, find the required ending allowance. This is the key. Remember, net carrying value equals gross accounts receivable minus allowance. Okay. Net carrying value minus net carrying value equals gross accounts receivable minus allowance for credit loss. Net carrying value is $235,000. Okay. So $235,000 is $270,000, which is the gross accounts receivable minus allowance. So allowance equals gross accounts receivable minus net carrying value. Okay, that's 35,000. Oh, okay. So the allowance is $35,000. The allowance is $35,000. This is the required ending allowance. Step 4, use your master equation. This is one of the 3 equations we've been mastering. Ending allowance equals beginning allowance minus write-offs plus recoveries plus credit loss expense. So here you plug in the numbers. 35,000 equals 40,000 minus 22,000 plus 8,000 plus expense. So you simplify it. Okay, I see. All right. So do we understand this question? What amount was recorded for credit loss expense on year 4 income statement? The first thing you need to find out is what is the required. Okay, what is the required ending? What is the required allowance? Ending allowance. Yes, what is the required ending allowance? You have a beginning allowance, which is $40,000. And they give it to you. It says allowance for credit loss January 1st, year 4. This is considered beginning allowance. That's $40,000. So the first thing you will need is ending required allowance. So how do you find ending required allowance? It is gross accounts receivable minus net carrying value. Gross accounts receivable minus net carrying value. So you have gross accounts receivable, which is accounts receivable at December 31st, year 4, $270,000. The net carrying value is $235,000. So here it's $35,000 required allowance. So now that you have ending required allowance, you can use the formula to find the expense. Use the formula to find the expense. Okay. What do they want? Credit loss expense for year 4. Whenever they ask for expense, your brain should immediately think, I need the required ending allowance account. Step 2, what do we have? We have beginning allowance $40,000, write-offs $22,000, recoveries $8,000, ending accounts receivable $270,000, net carrying value $235,000. Step 3, find the required ending allowance. This is the key. Remember, net carrying value equals gross accounts receivable minus allowance. So allowance equals gross accounts receivable minus net carrying value. Okay, so you do that, it's going to give you 35. So now that you have 35, this is the required ending allowance. Use the master equation. This is one of the 3 equations. Ending allowance equals beginning allowance minus write-offs plus recoveries plus credit loss expense. Credit loss expense is part of the equation. So once you can plug in the numbers, you will find it. Okay, so ending allowance equals beginning allowance minus write-offs plus recoveries plus credit loss expense. Okay. Help me understand this the equation. Why do we say minus write-offs? Why do we say plus recoveries plus credit loss expense? Explain the signs to me. Once you understand why each sign is positive or negative, you won't need to memorize the equation. Okay, so let's forget about accounting for a minute. Imagine the allowance account is a bucket. The bucket is called allowance for credit losses. Every dollar in the bucket is money you've set aside to cover customers who won't pay. Let's walk through the year. January 1st, you start the year with $40,000 in the bucket. Allowance bucket, $40,000. This is your beginning allowance. During the year, a customer does not pay. The customer owes $22,000. What do? You don't record another expense. You take $22,000 out of the bucket to cover the loss. Beginning bucket is $40,000. Take $22,000 out of the bucket, okay? Bucket left $18,000. That's why write-offs are minus, okay? Minus. That's why write-offs are minus, because you're taking money from the bucket, right? So you minus $22,000. This is a write-off. The customer will not pay. You write it off. And you take that money from the accounts accounts for credit losses. That's why write-offs are minus. They use up the allowance. Later, a customer you thought would never pay suddenly pays back $8,000. Earlier, you took $8,000 out of the bucket. Now you put it back. So bucket $18,000, put back $8,000. Now the bucket has $26,000. That's why recoveries are plus. They refill the allowance. End of the year, your accountant looks at all customers. He says, I think we need $45,000 in the bucket. But you only have $26,000. Current bucket, $26,000. You need $45,000. Missing $19,000. How do you get from $26,000 to $45,000? You record credit loss expense $19,000. Journal entry, debit credit loss expense, credit allowance. Now the bucket becomes $26,000 plus $19,000 equals $45,000. That's why credit loss expense is plus. It adds money to the allowance. It adds money to the allowance. Now the equation makes perfect sense. Start with what you had. Beginning allowance is $40,000. Customers didn't pay, minus write-offs. Some customers unexpectedly pay, plus recoveries $8,000. Need more money for next year's expected losses, plus credit loss expense. Now you have ending allowance $45,000. That makes sense. Okay, so the easiest way to remember the signs. You have the event. Beginning allowance, money already in the bucket. So that's the beginning allowance. This is where you start. You write off an account. When you write off an account, you're taking money from the bucket to cover that write-off. Minus. Take money out of the bucket. Recovery. Someone you thought would not pay unexpectedly sent you the money, so you plus. You add that to the bucket. put money back into the bucket, so plus. Credit loss expense. Add more money because future losses are expected. Okay, so credit loss expense. Add more money because future losses are expected. So you plus. Ending allowance, final amount left in the bucket. That's the result. Okay. So can you remember this? Understand the allowance for credit loss. All right. So beginning allowance for credit loss. You begin with $40,000, but a customer did not pay. So you're going to write off, minus write off. A customer who was not paying unexpectedly sent you $8,000. So you plus $8,000. This is recovery, plus recovery, minus write-offs, plus recovery, plus credit loss expense. Okay. So beginning allowance minus write-offs, plus recoveries, plus credit loss expense equals ending allowance. That makes sense. All right, so the deeper principle, the allowance for credit losses is a contra asset account with a normal credit balance. A write-off debits the allowance, which reduces its balance. A recovery credits the allowance after restoring the receivable, which increases its balance. Credit loss expense also credits the allowance, increasing it to the amount you estimate you will need at year end. That's why the equation is not something to memorize. It's simply tracking the balance of the allowance bucket from the beginning of the year to the end. Every sign tells you whether money is leaving the bucket or going into the bucket. Once you see it that way, the equation becomes a story instead of a formula. That's right. That's good. It's a story. That's good. The company has an 8% note receivable dated June 30th, year one. And the original amount of $150,000. Payments of $50,000 in principal plus accrued interest are due annually on July 1st, year 2, year 3, and year 4. The fair value option is not elected and there is no allowance for credit losses. In its June 30th, year 3 balance sheet, what amount should the company report as a current asset for interest on the note receivable? What amount should the company report as a current asset for interest on the note receivable? We need some help so we don't spend too much time thinking about it. This is a timeline question. No interest formula question. Once you draw the timeline, it's one of the easiest questions in the chapter. What do they want? At June 30th, year 3, how much current asset for interest should be reported? The keyword is June 30th, year 3. Okay. Let me try to understand that first. In original amount of $150,000. Payment of $50,000 in principal. Payment of $50,000 in principal plus accrued interest are due annually on July 1st, year 2, year 3, and year 4. The fair value option is not elected, and there is no allowance credit loss in its June 30th year 3 balance sheet. What amount should the company report? Okay, June 30th year 3. So ask yourself how much interest has been earned but not yet received as of June 30th year 3. Step 2, draw the timeline. June 30th year 1, July 1st year 2, June 30th year, July 1st year 3, July 1st year, okay, July 2nd payment. If repayment is made on July 1st, the balance sheet is June 30th year 3. That is 1 day before the next payment. Step 3. What is the principal on June 30th year 3? Original note, $150,000. Payment on July 1st year 2. Principal paid $50,000, so you have $100,000 left. Yes, remaining principal $100,000. Step 4. Has interest for year 3 been earned? Yes, from July 1st year 2. So July 30th year 3, exactly 1 full year has passed. So all the interest has been earned. Step 5. Calculate interest. Interest principal times rate. $100,000 times 8 is $8,000. Has been collected yet? No. Payment is tomorrow, July 1st. Therefore, it is interest receivable. Answer, $8,000. The timeline, all right. On the balance sheet, the balance sheet date, interest has been earned. Interest has not been collected. Therefore, record interest receivable. Whenever you see a note question, the step 1 is ask, what is the balance sheet date? Step 2, ask, what principal is outstanding on that date? Step 3, ask, how much interest has been earned but not collected? That amount is interest receivable. Many students mistakenly use the original $150,000 principal and get $12,000. But remember, after July 1st year 2 payment, the principal dropped to $100,000. Interest is always computed on the outstanding principal, not the original note amount. Okay. That's $8,000. Okay. Let's keep going. At January 1st year 4, the company had a credit balance of $160,000. Credit balance. And its allowance for credit losses. All right, so that's beginning allowance for credit loss. During year 4, the company wrote off $125,000, so minus $125,000 of uncollectible accounts. Okay, year 4's ending balance for accounts receivable was $550,000. Okay, in performing the evaluation of credit losses at year end, the accounts receivable aging schedule shows $485,000 of customer accounts are expected to be collected. So this is ending ending accounts receivable. And it's December 31st, year 4. Balance sheet. What amount should the company report as the allowance for credit losses? So that's the same thing. You need to find the required allowance for credit loss. Required allowance for credit loss is gross accounts receivable minus net carrying value. So do we have the net carrying value here? In performing the evaluation of credit losses at year end, the accounts receivable aging schedule shows $485,000. But before it says that the year 4's ending balance for accounts receivable was $550,000. This is the net carrying value, $550,000. But the gross is $485,000. So now we will do $485,000. All right, 485,000 minus 550. No, wait. Yes, all right. Oh, net carrying value. Receive year 4 ending balance for accounts receivable was $550,000. Okay. In performing the evaluation of credit losses at year end, the accounts receivable aging schedule shows $485,000 of customers' accounts are expected to be collected. Which one is the net carrying value? Balance for accounts receivable was $550,000. Is $550,000 a net carrying value? In that case, I would have 485 minus 550,000. I would have negative $65,000. Let me try this the inverse. $550,000 minus 485. That's $65,000. Okay, $65,000 as the ending allowance. All right, so you have the ending allowance. You have the beginning allowance. The beginning allowance is $160,000. That's the beginning allowance. So beginning allowance minus write-off plus recoveries plus credit expense will give you the ending. So what am I looking for is the what amount should the company report as the allowance for credit losses? Oh, so now I'm not looking for expense. I'm looking for how much should they report as the allowance for credit loss. So ending allowance for credit loss. Okay. So what do I have? I'm looking for ending allowance for credit loss. I have beginning allowance for credit loss, $160,000 minus write-offs. Let me do that. 65,000 ending. Okay. So 160,000 minus write-offs, 125,000 plus recovery. Do we have any recovery? Uncollectible. Year 4 ending balance for accounts receivable was, there is no recovery. Minus this, $35,000. This is taking me too much time. We have 6 minutes. Okay. This question is testing one idea. Can you find the required ending allowance for credit losses? This is what I found. Let's ignore everything that doesn't matter. What do they want? Allowance for credit losses on December 31st, year 4. Not the expense, okay? Not the write-off. They want the ending balance of the allowance for credit. I have the ending one. The ending one is the $65,000. That's it. All right, so let's see. Ending accounts receivable. Wait, what do we know? Beginning allowance is 160,000. Write-off is 125,000. Yes. Ending accounts receivable $550,000. Expected to collect $485,000. Step 3, think like the accountant. At year end, the accountant asks, out of my $550,000 of receivables, how much do I expect not to collect? That's exactly what the allowance represents. Expected collection is $485,000. Total receivables is $550,000. So 65,000. That means the company wants its allowance accounts to end the year with $65,000. That's right, I got it. But I didn't know if I got it. Oh, wow. So how do I make the difference between when they ask me for the amount the company should report as the allowance for credit loss and the expense? Because I already got the answer, but I didn't know if I got the answer. I was looking for something else. Here is the mental process I want you to use on every CPA question. Ask yourself one question. What account are they asking me to report? These are only two possibilities. Okay. What account are they asking me to report? That's the question we need to always ask. And there are only two possibilities. Possibility 1, they are asking about the allowance account. Balance sheet. Keywords: report allowance for credit losses, ending allowance, net realizable value, net carrying value, balance sheet. You're looking for how much should be in the allowance account at year end. How much should be in the allowance account at year end? You do not care how it got there. Examples: accounts receivable $550,000, expected collections $485,000. Immediately think allowance is $550,000 minus $485,000. The allowance is $65,000. You're done. Possibility 2, they are asking about credit loss expense, which is the income statement. Keywords: credit loss expense, bad debt expense, expense recognized, expense reported on the income statement. Now the question becomes, how much do I have to add to the allowance this year? Now you need beginning allowance, write-offs, recoveries, ending allowance, because you're trying to figure out the adjustment. Think about your bucket analogy. The allowance is a bucket. question 1, how much water should be in the bucket. You don't care how much was there yesterday. You only care at year end, how full should the bucket be? That's the allowance question. Question 2, how much water do I need to pour or to add into the bucket today? Now, you must know how much water was already there, how much leaked out, how much came back. That's the expense question. Okay. Compare the two. Question A, what should the company report as allowance for credit losses? You're reporting the balance. Think how much belongs in the bucket. Question B, what should the company report as credit loss expense? You're reporting the change. Think how much do I have to add to the bucket? Here's a shortcut I think you'll like. If the question asks allowance for credit losses, your brain should say, how full should the bucket be? Credit loss expense, how much do I need to add to the bucket? Okay. How much I need to add to the bucket. So for the first one, allowance for credit losses, how full the bucket should be. Let me finish with this before break. Let me finish with this idea so we don't come back to it. So how much do I need to add? No. How much should be in the bucket? Ending allowance equals gross accounts receivable minus expected collection, or gross accounts receivable minus net carrying value. Okay. All right. Gross accounts receivable minus expected collections, or gross accounts receivable minus net carrying value. Okay. The next one, how much do I, credit loss expense. Credit loss expense is how much do I need to add to the bucket. Ending allowance minus beginning allowance plus write-offs minus recoveries. Okay. Notice something important. When you're solving for expense, you're using the same equation you've learned. Ending allowance equals beginning allowance minus write-offs plus recoveries plus expense. Okay, if you rearrange that, you have expense equals ending allowance minus beginning allowance plus write-offs minus recoveries. Okay, that's good. All right, so we'll be back.
Days inventory outstanding. Ending inventory. Over cost of goods sold time. 365. Days inventory outstanding. Ending inventory. Over cost of goods sold times. 365. Days inventory outstanding. 365 over inventory. Turnover. Days inventory outstanding. 365 over inventory. Turnover. Days inventory outstanding. 365 over inventory. Turnover. Times interest earned. EBIT over interest expense. Times interest earned. EBIT over interest expense. Times interest earned. EBIT over interest expense. Accounts receivable. Turnover. Net credit sales over average accounts receivable. Accounts receivable. Turnover. Net credit sales over average accounts receivable. Accounts receivable. Turnover. Net credit sales over average accounts receivable. Inventory turnover. Cost of goods sold over average inventory. Inventory turnover. Cost of goods sold over average inventory. Inventory turnover. Cost of goods sold over average inventory. Cost of goods sold. Beginning inventory plus purchases minus ending inventory. Cost of goods sold. Beginning of goods sold. Gross profit. Sales minus cost of goods sold. Gross profit. Sales minus cost of goods sold. Return on assets. Net income over average total assets. Return on assets. Net income over average total assets. Return on assets. Net income over average total assets. Return on assets. Income over average total assets. Return on equity. Net income over average stockholders' equity. Return on equity. Net income over average stockholders' equity. Return on equity. Net income over average stockholders' equity. Debt ratio. Total liabilities over total assets. Debt ratio. Total liabilities over total assets. Debt ratio. Total liabilities over total assets. Debt to equity ratio. Total liabilities over stockholders' equity. Debt to equity ratio. Total liabilities over stockholders' equity. Current ratio. Current assets over current liability. Current ratio. Current assets over current liabilities. Current ratio. Current asset over current liabilities. Quick ratio. Cash plus marketable securities plus accounts receivable over current liabilities. Quick ratio. Cash plus marketable securities plus accounts receivable over current liabilities. Net profit margin. Net income over sales. Net profit margin. Net income over sales. Net profit margin. Net income over sales. Day sales outstanding. Day sales outstanding. Average accounts receivable over net credit sales times 365. Day sales outstanding. Average accounts receivable over net credit sales times 365. Day sales outstanding. Average accounts receivable over net credit sales times 365. Day sales outstanding. Ending accounts receivable over net credit sales times 365. Day sales outstanding. Ending accounts receivable over net credit sales times 365. Day sales outstanding. 365 over accounts receivable turnover. Day sales outstanding. 365 over accounts receivable turnover. Days inventory outstanding. Average inventory over cost of goods sold times 365. Days inventory outstanding. Average inventory over cost of goods sold times 365. Days inventory outstanding. Average inventory over cost of goods sold times 365. Days inventory outstanding. Ending inventory over cost of goods sold times 365. Days inventory outstanding. Ending inventory over cost of goods sold times 365. Days inventory outstanding. Ending inventory over cost of goods sold times 365. Days inventory outstanding. 365 over inventory turnover. Days inventory outstanding. 365 over inventory turnover. Days inventory outstanding. 365 over inventory turnover. Times interest earned. EBIT over interest expense. Times interest earned. EBIT over interest expense. Times interest earned. EBIT over interest expense. Accounts receivable turnover. Net credit sales over average accounts receivable. Accounts receivable turnover. Net credit sales over average accounts receivable. Accounts receivable turnover. Net credit sales over average accounts receivable. turnover, cost of goods sold over average inventory. Inventory turnover, cost of goods sold over average inventory. Inventory turnover, cost of goods sold over average inventory. Cost of goods sold. Beginning inventory plus purchases minus ending inventory. Cost of goods sold. Beginning inventory plus purchases minus ending inventory. Cost of goods sold. Beginning inventory plus purchases minus ending inventory. Gross profit. Sales minus cost of goods sold. Gross profit. Sales minus cost of goods sold. Gross profit. Sales minus cost of goods sold. Return on assets. Net income over average total assets. Return on assets. Net income over average total assets. Return on assets. Net income over average total assets. Return on assets. Income over average total assets. Return on equity. Net income over average stockholders' equity. Return on equity. Net income over average stockholders' equity. Return on equity. Net income over average stockholders' equity. Debt ratio. Total liabilities over total assets. Debt ratio. Total.
All right, we are back. Get back to work. Let's do it. And there's mosquito. Really? I was outside. It's really hot outside. Okay. Let's go back. Okay, let me go back to this question. At January 1st, year 4, the company had a credit balance of $160,000 in its allowance for credit losses, which is considered the beginning allowance. During year 4, the company wrote off $125,000 of uncollectible accounts. Year 4's ending balance for accounts receivable was $550,000. In performing the evaluation of credit losses at year end, the accounts receivable aging schedule shows $485,000 of customer accounts are expected to be collected. In its December 31st, year 4 balance sheet, what amount should the company report as allowance for credit losses? In this case, we're not looking for the expense. The only thing we need is gross accounts receivable minus net carrying value. Right? Net carrying value is what you're expecting to collect. What you're expecting to collect. All right. So we do that and that's it. Okay, that's good. Which of the following method for recording credit losses is compliant with GAAP and accrual accounting? Direct write-off, allowance. Allowance, yes. Direct write-off, no. Direct write-off, no. Allowance, yes. Which of the following method for recording credit losses is compliant with GAAP and accrual accounting? So accrual accounting is allowance for credit loss. Yeah. That's correct. Finally, I did one of my own. The two methods for recognizing credit loss or bad debt expense are the allowance method required for financial reporting and the direct write-off method required for tax reporting. Okay. The allowance method, which adheres to the current expected credit loss model, is consistent with GAAP and accrual accounting. This method uses an allowance for credit losses contra account to record expected credit losses. Each reporting date, the allowance is adjusted so the account receivable net carrying value equals what is expected to be collected. Conservatism principle. Okay, conservatism principle. The credit loss expense is recognized or matched with the current period's revenue. The direct write-off method is not consistent with GAAP or accrual accounting balance. It violates the matching and conservatism principle. Okay. That's all you need to know. Okay. The company factored the recourse $90,000 of its accounts receivable with an allowance for credit losses of $1,800. The factor retained 8% of the accounts receivable as an allowance for sales returns and disputed receivables. A 4% commission on the gross amount of the factored receivables was charged. What amount of cash did the company receive from the factored receivables? $90,000 of its accounts receivable with an allowance for credit losses of $1,800. So in this case, it's going to be $90,000 minus $1,800. It's going to be $88,200. $88,200, right? Yes. 90,000 minus 1,800, 88,200. Okay. So the factor retained 8% of the accounts receivable as an allowance for credit for sales returns. Allowance for sales returns. And disputed receivable. That's allowance. This allowance will also, I believe, I don't know yet, but it should also reduce the accounts receivable. $88,200. 8% of that is $7,056. $7,056. So we would do 88,200 minus 7,056. So we have $81,144. A 4% commission on the gross amount of the factored receivable was charged. 4% commission was charged. So 4% on the 81,000. Okay. Let me do times 4% or times 96%. So I can have the final amount. times 0.96%, $77,898.24. $77,898. I don't have an option like this. I have a 77,400. I think I may have calculated something too soon. So let me get some help. Okay. This question is another one where the language is harder than the math. Yes. What do they want? How much cash did the company receive? Forget everything else. Think cash equals receivables minus everything the factor kept. Yes, that's what I was trying to do, but let's see. Step 2, what did the factor kept? There are only 2 deductions. Holdback retained, the factor retained 8%. This is not a fee. It's like a security deposit that may be returned later. $7,200 of $90,000. Okay. Yeah. Yes. $7,200. Commission. The factor also charged 4% commission. This is a fee. It's from the 90,000. The commission is from the 90,000. Step 3, calculate cash. Start with the receivable. $79,200. Yeah. $90,000. So credit loss. What about with an allowance for credit losses of $1,800? Why we did not subtract the $1,800 allowance for credit loss? I believe this would reduce accounts receivable. The key is this. The $90,000 is the gross accounts receivable being factored. The problem says the company with recourse $90,000 of its accounts receivable within allowance for credit losses of $1,800. That $1,800 is simply telling you that the receivables already had an associated allowance on the books. It is not something that factor subtracts when determining the cash paid. Think of the balance sheet before the sale. Gross accounts receivable, $90,000, less allowance for credit losses, $1,800. Net carrying amount is $88,200. The factor does not buy the net carrying amount. The factor buys the receivables themselves, whose face amount is $90,000. The factor says, I'm buying receivables worth $90,000. Then it computes its deductions from $90,000, hold back 8%, commission 4%. Okay, so what happens to the $1,800 allowance? It does not disappear. It is removed from the books as part of the accounting for selling the receivables. It affects the journal entry in the gain or loss on the transfer not the amount of cash the factor pays. A good rule for the CPA exam: ask yourself, who is subtracting the amount? If the factor is determining how much cash to give you, it subtracts only the amount it keeps, the holdback, the commission, the interest, etc. The allowance for credit losses is your accounting estimate, not the factor's deduction. I see. That's why the $1,800 is not subtracted from the cash received. Okay. This is a common CPA exam trap. It's a trap. They include the allowance hoping you will think accounts receivable should be net of allowance. But the question is not asking for the carrying amount on your balance sheet. It is asking how much cash the factor paid. And the factor bases that on the gross receivable transferred. Okay, makes sense. And when you are doing the factor, the holdback of the factor and the commission has to be on the total amount. Okay, on the total amount. Got it. On March 31st, year 3, the company had an adjusted credit balance of $1,000 and its allowance for credit losses. Okay, so March 31st, year 3, unadjusted credit balance of $1,000, allowance for credit losses. An analysis of the company trade accounts receivable at that date revealed the following: age 0 to 30 days, amount $60,000, estimated uncollectible 5%. 31 to 60 days, $4,000 amount, estimated uncollectible 10%. Over 60 days, $2,000 amount, estimated uncollectible 70%. What amount should the company report as allowance for credit losses in its March 31st, year 3 balance sheet? March 31st, year 3. Okay. Let me see what they're asking here. If the age is 0 to 30 days, is 5%. 31 days to 60 days is 10%. Over 60 days is 2%. It's $2,000 but 70%. Yeah. Need to understand this idea. This question is another example of something we've been talking about. The biggest question is, what account are they asking for? They ask, what amount should the company report as allowance for credit losses? That means they want the ending balance of the allowance account, not the expense. Okay. Calculate the required ending allowance. The aging schedule tells you how much each group is expected to be uncollectible. Age 0 to 30 days, $60,000, 5%. expected loss $3,000. 31 days to 60 days, $4,000. 10%, $400. Over 60 days, $2,000. 70%, $1,400. Oh, here you're gonna add them all. Not add, now add them. You add them up. 3,000 plus 400 plus 1,400 is $4,800. So the company wants the allowance account to end at $4,800. That is the answer. Why didn't we use the $1,000? The problem says unadjusted credit balance of $1,000. Many students immediately think I should add it or subtract it. Not yet. Ask yourself, are they asking for allowance account or the expense? They're asking for allowance for credit losses. They're asking for allowance for credit losses. So the answer is simply $4,800. The $1,000 is there because if they had asked, what is the credit loss expense? Then you would use it. If the question had asked for the expense, so beginning unadjusted allowance equals 1,000, required ending allowance is 4,000, expense needed is 4,800 minus 1,000, so it would be 3,800. Okay? Notice how the same problem can ask two different questions. If they ask allowance for credit loss, they ask for allowance for credit loss, the answer is for $4,800. If they ask for credit loss expense, the answer would be $3,800. Okay. Here is the pattern to memorize, not the formula, but the thinking. If they give you an aging schedule, your brain should immediately think, this schedule tells me what the ending allowance should be. Then ask one question. Are they asking for the allowance? Stop. The aging schedule already gives you the answer. Are they asking for the expense? Now compare the required ending allowance with the current allowance. Okay, that's good. This is good. So now, in a question like this, on March 31st, year 3, the company had an unadjusted credit balance of $1,000 in its allowance for credit losses. An analysis of the company's trade accounts receivable at that date revealed the following. The age 0 to 30 days, 60,000. Estimated uncollectible 5%. Age 31 days to 60 days, $4,000. That's the amount. Uncollectible is 10%. Over 60 days is $2,000. Estimated uncollectible 70%. So what you're gonna do is to do the percentage of each amount and then add the percentage, add them together. That will give you the allowance. What is the question? The question is, what amount should the company report as allowance for credit loss? They're asking for the allowance, not the expense. So two options. They can ask for the allowance or ask for the expense. If they ask for the allowance, you will find the allowance. You add up the percentage amount and it will give you the allowance. If you're looking for the expense, you will make the difference between the beginning unadjusted balance and the allowance, the ending allowance that will give you the expense or what's missing. Makes sense. That makes sense. 4,800. Okay. At December 31st, year one, the company's allowance for credit losses had a credit balance of $30,000. During year two, the company wrote off uncollectible accounts of $45,000. At December 31st, year two, an aging of the accounts receivable indicated that $50,000 of December 31st, year two, receivables may be uncollectible. What amount of allowance for credit loss should the company report in its December 31st, year two balance sheet? Now you start to see. You start to see here, right? Because they are not asking for expense. They are only asking for the credit loss. All right? There is no expense here. What amount of allowance for credit loss? They are only asking for the allowance. So if they are only asking for the allowance, we need to find the allowance. What do we have? We don't need the beginning allowance. They say allowance for credit loss had a credit balance of $30,000. This is the beginning. All right, during year two, they wrote off uncollectible. We don't need the write-offs because we're not calculating the expense. At December 31st, year two, an agent of the accounts receivable indicated that $50,000 of the December 31st, year two receivables may be uncollectible. This is the answer. The answer is $50,000. They already tell you that $50,000 will be uncollectible, may be uncollectible, or will be uncollectible. What amount of allowance for credit loss should the company report is the $50,000. The answer is in the question in this case. Okay. This one is done. That's good. Let's get another set. Get another set of 10. It's 10. Okay. It's good when you start to understand. Because the answer is already there. It's just need to understand. On July 1st, year one, the company sold equipment to Mando Co. for $100,000. The company accepted 10% note receivable for the entire sales price. The fair value option was not elected. This note is payable in 2 equal installments of $50,000 plus accrued interest on December 31st, year one and year two. On July 1st, year two, the company discounted the note at a bank at an interest rate of 12%. The company's proceeds from the discounted note okay, so what is the proceed from the note? Almost the same as the question we just did. Okay. So what do we have? First of all, what is the question? What do they want? What is the proceed from the discounted note? Okay. What's the proceed from the discounted note? What did we have? How much did the company receive? So what do we have? For $100,000, sold equipment for $100,000. All right. Accepted a 10% note receivable for the entire sales price. So now the entire sales price, the value is $110,000. Okay. $110,000. The fair value option was not elected. This note is payable in 2 equal installments of $50,000 plus accrued interest on December 31st, year 1 and December 31st, year 2. On July 1st, year 2, okay, the company discounted the note at a bank, and the bank wanted 12%. The bank wanted 12%. Let me see if we can do that. If not, we'll find some help. What do we have? What do we have? We have $110,000. $110,000. This is by adding the 10%. Okay? It's not $110,000 anymore. This note is payable into 2 equal installments, $50,000 plus accrued interest on December 31st, year 1. So December 31st, year 1, you already receive a payment of $50,000 plus the interest. So now what we're working with right now is $50,000. We're working with $50,000 from December 31st, year 1. December 31st, year 1, you receive the money. So next year, we have $50,000 in the account at 10%. So that's $55,000. $55,000. The bank wants what? The bank wants 12%. And it's going to be there for 1 year. But it's in July. July is the 7th month of the year. It was July 1st. So we have 6 months left. July 1st, we have 6 months left. Okay. What we're going to do in this case is $55,000 times 6 divided by 12. Okay. 55,000 times 6 months divided by 12. That's $2,750. How much are you going to receive? It's 55,000. No. I did 5,500. All right, it's 55,000. That's $27,000. 55,000 times 6 divided by 12 is $27,500. No. Why did I say times 6? Wait, okay, times 12%. First of all, 12%. Times 12% times 6 divided by 12. Okay. So $3,300. So 55,000 minus 3,300. $51,700. So that's what you're going to receive. Let me see if this is correct. That's correct. Okay. That's good. That's good. So we understand. So let's explain that again. On July 1st, year one, the company sold equipment to Mandoco for $100,000. So you have a $100,000 note. The company accepted a 10% note receivable for the entire sales, for the entire $100,000. The fair value option was not selected, was not elected. The note is payable in 2 equal installments of $50,000 plus accrued interest on December 31st. Accrued interest on December 31st, year one and year two. And year two, on July 1st, year two, the company discounted the note at a bank at an interest rate of 12%. So here, the company already received the first payment before it discounted the note. And you see what we did. You had the note for 6 months after the first payment. So, and the company wanted 12%. So that's why. And it was a 10% note. You have $50,000 left, so that's why it's $55,000 times the 12% that the bank wants, times 6 months remaining, divided by 12 months of the year. That's good. The company's allowance for credit losses had a credit balance of $24,000 at December 31st, year one. A credit balance of $24,000. During year two, the company wrote off uncollectible accounts of $96,000. The aging accounts receivable indicated that a $100,000 allowance for credit losses was required at December 31st, year two. What amount of credit loss expense should the company report for year two? Now, I start to understand. It is asking for credit loss expense. So what is missing? Okay. What is missing? What do we have? All right. So the company's allowance for credit loss had a credit balance of $24,000. This is the beginning at December 31st, year one. All right. And we're talking about year two. So December 31st, year one is the ending of year one, but it's the beginning of year two. $24,000 is beginning for year two. During year two, the company wrote off uncollectible accounts for $96,000 minus write-offs. The aging of accounts receivable indicated that a $100,000 allowance for credit losses was required at December 31st, year two. So we have the required. Do we have the beginning? We have the beginning, which is $24,000 for the beginning. But we have a write-off of $96,000. So beginning minus write-offs plus recoveries plus expense, but we don't have any of these. 24,000 minus 96,000, that's going to give us a negative number. Negative 72,000. Okay. And we have the allowance for credit loss. The required allowance for credit loss is 100,000. So it's gonna be 172,000 because we already negative 72,000 here. We're already negative 72,000, and we need 100,000. So that negative, we need to fill it up, and then we need to add the 100,000. So it's going to be 172,000. That's what I believe. That's correct. Yes. That's correct. Okay. All right. At the end of year one, the company had an ending balance in allowance for credit losses of $30,000. This is the ending at the end of year one. But during year two, now we're talking about year two, so it's not ending anymore, it's beginning. The $30,000 is ending of year one, but beginning of year two. But now we left year one, we're talking about year two. All right, so during year two, the company wrote off $40,000 of accounts receivable. Okay, wrote off $40,000. At the end of year two, while performing the evaluation of credit losses, the company determined that 8% of the $300,000 ending accounts receivable balance would be uncollectible. What amount should be reported as a credit loss expense? All right, you start to see now, they're not asking for allowance, they're asking for the expense. What is missing? So do we have the beginning? Do we have the ending? And the difference is going to be the expense. Okay? What is the beginning? The beginning of year two is $30,000. During year two, the company wrote off $40,000. So we are negative $10,000 now. We're negative $10,000. We don't have recoveries. We don't have extra expense. So we don't have nothing to add to fill that up. So we are negative $10,000. Okay. At the end of year two, while performing the evaluation, the company determined that 8% of $300,000 ending accounts receivable balance would be uncollectible. So that's 8% of this is the ending allowance. So 8% of 300,000. $0.08. It's $24,000. So the ending is $24,000. Ending beginning is negative $10,000. As we can see, the reason we say negative $10,000 because we had a beginning of $30,000. We wrote off $40,000, so we have a $10,000 negative. $10,000 negative. The ending balance is $24,000. The ending balance is $24,000. What amount should be reported as a credit loss expense? All right, so the ending balance should be $24,000. But we have a negative $10,000. We need $24,000. So now the expense is going to be $34,000. Yes. The 24 that we need plus the negative 10,000. That's correct. Excellent. Let's keep moving. The company pledged some of its accounts receivable to Good Neighbor Financing Corporation in return for a loan. Okay. In return for a loan. It's a pledge. Which of the following statement is correct? A pledge, when there is a pledge, the bank will not take ownership. Right? The bank is not taking ownership. That's one thing you need to remember. Good neighbor financing cannot take title to the receivables if the company does not repay the loan. The title can only be taken if the receivables are factored. That's wrong. So if they don't pay, they can take ownership of the receivable. Good neighbor financing will assume the responsibility of collecting the receivable. No, they will not assume the responsibility of the receivables. The company will retain control of the receivables. Yes, the company retain the control of the receivables. That's correct. Good neighbor financing will take title to the receivables and will return title to the company after the loan is paid. No, they will not take title of the receivables. And that's correct. Okay, it's a pledge. It's a pledge. Okay. Pledging involves borrowing cash and using part of the accounts receivable as collateral to ensure a loan. Age and creditworthiness of the receivables are taken into consideration by the lender. The entity records the loan, and the pledge must be adequately disclosed in the footnote on the financial statements. There is no change in control or transfer of ownership of the receivables. The entity, not the lender, still bears the risk of uncollectible accounts. Okay, so it's a pledge. All right. Under the current expected credit loss model, what impact will collecting a previously written off account have on the balances of accounts receivable and allowance for credit losses? What's going on here? A customer was uncollectible. It was written off. You were not expecting to receive that money. That means that money was removed from accounts receivable. It was also removed from allowance for credit losses. Unexpectedly, the customer paid. What impact the collecting will collecting a previously written? Yes, now the customer paid unexpectedly. What's going to happen to accounts receivable? You collect the money. You will need to open accounts. You will need to add it to accounts receivable again. And allowance for credit loss will also increase. But let me see. No change, decrease. No change, increase. Increase, decrease. Increase, no change. Accounts receivable will increase because it was a written off account. Now you add it back to accounts receivable. Your accounts receivable will increase, or maybe there would be no change in accounts receivable because accounts receivable did not decrease. When you remove it because you took money from allowance to put into accounts receivable to cover for this loss. When they pay, you will take that money, add it to allowance. Allowance will increase, and there will be no impact on accounts receivable. These are my thoughts. No change, increase. No change in accounts receivable, but allowance for credit losses will increase. Let me see if that's correct. Let's see if this is correcto. All right, let's see. This question is actually testing whether you understand the two-step recovery process. Let's go back to the story. The life of a bad account. You write it off. The customer owes $1,000. Journal entry, debit allowance for credit losses, $1,000. Credit accounts receivable, $1,000. Remember, credit in accounts receivable will decrease accounts receivable, okay? Accounts receivable decrease, allowance for credit loss decrease. Result, accounts receivable decrease, yes, allowance decrease, okay? Decreases. Step two, months later, the customer unexpectedly pays. Can you collect money from an account that no longer exists? No. So first you must restore it. Okay, so journal entry, accounts receivable $1,000, debit, credit allowance for credit losses $1,000. The result, accounts receivable increase, allowance increase. Step 3, now collect the cash. Journal entry, debit cash $1,000, credit accounts receivable $1,000. So when you credit accounts receivable, it decreases accounts receivable. The result, account cash goes up, accounts receivable goes down. Now answer the question. The question asks, what impact will collecting a previously written off account have on the balance of accounts receivable and allowance? Notice the wording. It says collecting, not restoring. So you collect the cash. Collecting a previously written off account includes both journal entries. Let's combine the effects. Accounts receivable restore goes up. Collect the money, accounts receivable goes down. Net effect, no change. You gotta understand that, right? The money comes in, the money goes out, there is no change, right? The money comes in, it goes up, the money goes out, it goes down, there is no change, no net change. This is what you gotta understand. Allowance, restore $1,000, collection, no effect, net effect, increase. Final answer, exactamente. No change in accounts receivable, but increase allowance for credit losses. Okay? Because when you collect the money that was written off, you restore it in accounts receivable, that causes accounts receivable to increase. If it was only the restoration, you would say accounts receivable increased. But you collected the cash. The moment you collect the money, it gotta be taken off accounts receivable. So accounts receivable will go down, will decrease. So if it goes up and then it goes down, there is no net change. Okay, that makes sense. Makes sense. Let's keep going. The company received from a customer a 1-year, $750,000 note bearing annual interest of 9%. After holding the note for 6 months, the company discounted the note without recourse at National Bank at an effective interest rate of 12%. What amount of cash did the company receive from the bank? We have done that like 2 times already, so now we should be able to do it on our own. All right, so the company received from a customer a 1-year note, $750,000, note bearing annual interest of 9%. So let's just add the 9% on this before we move forward. Okay, $750,000 at 9% times 0.09. It is $67,500. So add it. $750,000 plus $67,500, or $67,500 plus $750,000. So that's $817,500. Okay. So that's the total amount. Total amount of the note. 9%. Yes. Okay. You held it for 6 months, and then you go to the bank to receive money for the note. The bank requires 12%. So what you're gonna do is the total amount, the $817,500 times the amount that the bank requires, which is 12%, 0.12%, times 6 months remaining, times 12 months of the year. The total is 7,000. Not time, divided by 12 months of the year. All right, that's $49,050. $49,050. This is the discount. All right, so this is the discount. So how much you're gonna receive? You will do $817,500 minus $49,050. $49,050. Let me do that. $49,050 minus $49,000. $49,050. You will receive $768,450. $768,450. Let's see. That's correct. Okay. In year 4, a company has a 2-year $50,000 8% interest bearing note receivable. 2-year $50,000 8% interest bearing note receivable. In year 5, when there is 1 year remaining on the note, the company discounted the note with recourse to a local bank, which has a 10% discount rate. Which of the following statement is not true regarding the discounting of the note receivable in year 5? So first of all, I need to know what's true, because here they give me the company received. Okay, what's true? I just need to know what's true. Okay, so in year 4, a company has a 2-year $50,000 8% interest bearing note receivable. In year 5, when there is 1 year remaining, year 5, 1 year remaining on the note, the company discounted the note with recourse to a local bank, which has a 10% discounted rate. So first of all, let's add 8%. So that's $54,000. 8% on 50,000 is 54,000. But 2-year $50,000. I don't understand the 2-year $50,000. is not true. The company received $52,000. Company recorded a note receivable discounted for $50,000. The company recorded a current liability. All right, a current liability of $58,000. The company disclosed the footnotes to the financial statement a contingent liability of $58,000. Which one is not true? The company received $52,200 cash proceeds from the bank. May be true. Company recorded a note receivable discounted for $50,000. That could be true. The company recorded a current liability of $58,000. Current liability of $58,000. No. Why would it be $58,000? The company disclosed in the footnote. Okay, yes, you need to disclose it in the footnote. But let me see. That's correct. Okay. All right. The company recorded a current liability of $58,000. No, you cannot do that. So why not? Okay. All right. So the answer is I chose the right answer. Do I know exactly how to explain it? Not really. So let's keep moving. All right. We have 3 questions left. Let me see what time it is. Oh, 8 minutes. Wow. 1 hour is almost. All right, so on April 1st, the company factored $80,000 of its accounts receivable without recourse. The factor retained 10% of the accounts receivable as an allowance for sales returns and charged 5% commission on the gross amount of the factored receivables. What amount of cash did the company receive from the factored receivable? Okay, so $80,000 minus the 10%, minus 5%. So I would say minus 15%. What is 15% of $80,000? Or I would say $80,000 times 85%. This is what you received. You received $68,000. Yes. That's 85% of 80,000. Correct. All right. Excellent. When the allowance method of recognizing uncollectible accounts is used, what effect would the following transactions have on the allowance account? Recognize credit loss expense, write off a specific account. When allowance method of recognizing uncollectible accounts is used, allowance, what effect would the following transaction have on the allowance account? On the allowance account, when you recognize credit loss expense, you recognize credit loss expense. What happened to the allowance? The allowance increase. The allowance increases because expense, you add the expense on the allowance, on the beginning allowance. Write off a specific account, it decreases the allowance when you write off. I would say that. That's correct. That's good. Our judgment is start to be good. Okay. Okay. Recognize credit loss expense. You recognize credit loss expense. It increases allowance. You write off. It decreases allowance, and this comes from the formula. Beginning allowance minus write-off plus credit loss expense. That's good. Okay. All right, let's keep going. Last question. Based on the analysis of historical loss information and relevant data, at the end of year 2, the company estimates that 95% of accounts receivable will be collectible. The year-end balance in accounts receivable was $640,000. During year 2, the company wrote off $35,000 of uncollectible accounts. The allowance for credit losses had a $28,000 balance on January 1st, year 2, beginning. In its income statement on December 31st, year 2, what amount should the company report as credit loss expense? The expense. So what do we need to calculate the expense? We need the beginning. We need the beginning allowance. We need the ending allowance. And then we can calculate the expense. If there is any write-off, any recovery, we can play with this to find the result, the answer. All right, so what do we have? 95% of accounts receivable will be collectible. They can collect 95% of accounts receivable. The year-end balance in accounts receivable was $640,000. So 95% of this can be collected. In that case, there is 5% of this that will be uncollectible, which is the ending allowance. All right, let's do that. $640,000 times 0.05%. So 32,000 is the ending. Is the ending allowance. During year 2, the company wrote off $35,000. Okay, wrote off $35,000. The allowance for credit loss losses had a $28,000 balance in January 1st, year 2. So beginning, so they just mixed it up. But beginning is $28,000. Beginning is $28,000. You write off $35,000. All right, you write off $35,000, and we need $32,000 at the end. Okay, at the end we need $32,000. You had a beginning of $28,000, and then you write off $35,000. So we are negative $7,000. Negative $7,000, and we need $32,000. So the ending would be $39,000. What you need is $39,000. Correct. Woof. This is good. This is good. All right. Well, thank you very much, everybody, for sticking around. This was a great session because I see that we understanding it. All right.
Day sales outstanding, average accounts receivable, over net credit sales times 365. Day sales outstanding, average accounts receivable, over net credit sales times 365. Day sales outstanding, average accounts receivable, over net credit sales times 365. Day sales outstanding, ending accounts receivable, over net receivable turnover. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, ending inventory over cost of goods sold times 365. Days inventory outstanding, ending inventory over cost of goods sold times 365. Days inventory outstanding, ending inventory over cost of goods sold times 365. Days inventory outstanding, 365 over inventory turnover. Days inventory outstanding, 365 over inventory turnover. Days inventory outstanding, 365 over inventory turnover. Times interest earned, EBIT over interest expense. Times interest earned, EBIT over interest expense. Times interest earned, EBIT over interest expense. Accounts receivable turnover, net credit sales over average accounts receivable. Accounts receivable turnover, net credit sales over average accounts receivable. Accounts receivable turnover, net credit sales over average accounts receivable. Inventory turnover, cost of goods sold over average inventory. Inventory turnover, cost of goods sold over average inventory. Inventory turnover, cost of goods sold over average inventory. Cost of goods sold, beginning inventory plus purchases minus ending inventory. Cost of goods sold, beginning inventory plus purchases minus ending inventory. Cost of goods sold, beginning inventory plus purchases minus ending inventory. Gross profit, sales minus cost of goods sold. Gross profit, sales minus cost of goods sold. Gross profit, sales minus cost of goods sold. Return on assets, net income over average total assets. Return on assets, net income over average total assets. Return on assets, net income over average total assets. Return on assets, income over average total assets. Return on equity, net income over average stockholders' equity. Return on equity, net income over average stockholders' equity. Return on equity, net income over average stockholders' equity. Debt ratio, total liabilities over total assets. Debt ratio, total liabilities over total assets. Debt ratio, total liabilities over total assets. Debt to equity ratio, total liabilities over stockholders' equity. Debt to equity ratio, total liabilities over stockholders' equity. Current ratio, current assets over current liability. Current ratio, current assets over current liabilities. Current ratio, current asset over current liabilities. Quick ratio, cash plus marketable securities plus accounts receivable over current liabilities. Quick ratio, cash plus marketable securities plus accounts receivable over current liabilities. Net profit margin, net income over sales. Net